Welcome to M&A Talk, the #1 podcast on all things related to mergers and acquisitions. Brought to you by Morgan and Westfield.
What's the difference, so we can clarify that for the listeners, because I think some might be confused. What's the difference between commercial and operational due diligence?
So I'll tell you how they're different and where they intersect. Commercial diligence tests the revenue line, growth, margins, new offerings to to customers. Are they willing to pay for them? Do they want them? Are they willing to pay for them? How much are they willing to pay? Why would they switch? And the process of switching. Operational diligence is focused on the cost line. How do other industry peers perform? And then there's the bottom-up diligence piece of it, which is you're going function by function, and you're evaluating what the potential cost reductions are, by function. And just to add to that, where they intersect is around margins. Because if you think of, I'm assuming we're going to get to valuations, what are you doing in valuations? Well, it's revenue growth, margins, how long will those margins go on for, et cetera, capital investment required. So, commercial diligence focuses on the revenue line, operational diligence on the cost line, but also capital investments required to drive the plan, those one-time costs that might be required. And where CDD and ODD intersect is around margins, margin sustainability.
How do you bring the strategy into the due diligence process and kind of test the hypothesis of your strategy?
That's a great question. You should be leaving an M&A strategy exercise with hypotheses that you're going to test in diligence. Like I said in the beginning, know what you want, why, and how you're going to create value. In diligence, you're testing your propositions about how you're going to create value.
Can you think of an example of hypotheses from an actual company?
Oh, sure. So hypotheses can be anything from how sustainable is the current business, the current operations value of the company? What's the stability of recurring revenues? And or they could be the potential of putting a new bundled offer in the market and testing whether customers want that. Are they willing to pay for it? How much are they willing to pay?
Could you think of an example of that with a live company that you've worked with?
So one of the things that we'll look at is targets will claim they have a certain addressable market, but that doesn't mean they can serve it. And so the addressable market for a company is what you might serve with additional capabilities or market access, but the addressable market is what you can actually serve today. And differentiating those is really important. And the question I always ask folks is, what do you think companies do? Do you think they overstate their market share, or do they understate their market share? They tend to understate it. And you know why they understate their market share? Is because it leaves them headroom for growth in the valuations, gets you a higher price. And so it's really important that you differentiate between the addressable market and the actual serviceable market that they serve today. And there was one time I was in a room with a private equity firm, and we were serving, and the target CEO and CFO. And they said they had 20% market share, but they really had 40% market share. And so that would drive a very different valuation. And the CEO said, how did you do it? Like, how did you find that out? And this is a senior manager I was working with at the time. I love the guy. He goes, we just counted the butts in seats. It was a government procurement software. And we just counted the licenses, And the CEO of the target offered my senior manager a job on the spot. But those are the things that you're really looking for, because remember what I said early on, diligence doesn't just drive a go or no-go decision. It drives the inputs to your valuation, and it drives the inputs to your integration planning.
What do you mean by it drives the inputs to your valuation? Because don't you do valuation before diligence?
Well, in many cases, yes. In that case, you're testing the assumptions that are being put into the valuation model. I mean, think about a valuation model. It starts with revenues today, revenue growth, and then you have costs, and then you have margins. So it's a sustainability of those margins over time. And then you have the capital investment required, your working capital investments and your fixed asset investments. And if you understate the investments required to drive the growth, or you overstate margin or the revenue growth, and then you put a terminal value on a valuation with those overstated assumptions, you end up with a overvalued asset.
Very interesting. Very good point. Of course, if you're using DCF, which if you're valuing a public company, you probably are, Do you see a difference in how strategic acquirers and private equity groups conduct due diligence?
We would have said so in the past, but I think these days that private equity is looking so much as they do acquisitions along a pathway, not just standalone pieces where they're going to improve performance by putting a new management team in. Both private equity and corporates are looking at growth and, what the customers want and what the growth prospects are for the company in the future, along with the ability to improve costs.
What do you think? I might have asked this, but I really want to drive this point home. What do you think most companies overlook in the due diligence process?
That's actually a complicated question in the sense that if you start out trying to boil the ocean, you're going to get the important things lost. And so the way we think of, let's say, commercial diligence, it's three major buckets. What's the market look like? What are the headwinds and tailwinds in the market? What's the growth rate of the market? Both the addressable and the serviceable market for the target. And then the second thing is then it gets focused on the target. How is the target positioned in the market? What segments does it serve well versus those that maybe it doesn't? And how's that positioning changed over time? Because positioning isn't static. You can sort of, look at who are the new competitors coming in and attacking that target in certain markets, where have they been able to improve, where are they, say, less well positioned. And then the third major basket or bucket is what are the opportunities for improvement? And that gets you to your synergies, both on the revenue side and the cost side.
So when I say, what do you think companies overlook? What exactly are you saying that they overlook in the due diligence process?
Well, one of the things is confusing the addressable market with the serviceable market and overstating growth. That's a big one. On the cost side, it's mixing up already planned cost takeouts with cost synergies. There's a key phrase. I think this is the one you're looking for. If but for the deal. What does doing this deal allow us to do that we couldn't have done otherwise? And the answer to your question is the answer to that.
M&A Talk is brought to you by Morgan & Westfield, a nationwide leader in mergers and acquisitions for small to mid-market companies. If you've enjoyed this show, don't forget to subscribe and leave a review. Learn more at morganandwestfield.com. While we take reasonable care to select recognized experts for our podcast, please note that each podcast presents the independent opinions of such experts only, and not of Morgan & Westfield. We make no warranty, guarantee, or representation as to the accuracy or sufficiency of the information provided. Any reliance on the podcast information is at your own risk. The podcast is for general information only and cannot be considered legal or professional advice.